Hi, everybody, and welcome back to video number 5 in chapter 6. And when we left off, we were looking at how we would use the effective interest method to amortize a discount from this previous slide here, right? And we had this $480 discount. So what we're going to do here is we're starting with the amount of the note, which was discounted here, and it's going to ripple up to $10,000. And what we do is we take 10%. Okay, so remember, 12% is what's written on the note, but 10% is our effective rate. So we're going to use that to compute this $1,000. And that is going to mean that our interest revenue is going to be the 12%, that's the revenue now, of $11.59. But there's a discount, then the difference between these two of, in this case, $142, and in this case, $159, etc. And as it goes, it ratchets up to $10,000. Okay. So we're going to prepare the journal entries to record that interest revenue at the end of years 1 and 2. And there it is. No surprise there. The cash is going to be $1,000 that we're going to receive on that note, but interest revenue is going to be more than that, right? Okay. All right. Now we're going to prepare the journal entries to record the interest revenue at the end of year 3, and then to record the cash when the issuer pays the face amount at maturity. So again, we'll do our last year here, just like we did the first two, picking off the discount on the note receivable. And then by that time, the carrying value is the same as the notes receivable, and so at maturity, no matter if it's a premium or a discount or at face value, we're going to debit cash and reduce our accounts, our notes payable for that. Okay, in a bargain transaction then, here we're going to look at notes received for property, goods, or services. And in a bargain transaction entered into at arm's length, the stated interest rate is presumed to be fair unless there's no interest rate stated, or the stated interest rate is totally unreasonable, or the face value of the note is materially different from the current cash selling price. So here, Oasis Development Company sold a corner lot to Rusty Pelican as a restaurant site. I enjoy that restaurant quite a little bit out here in Newport Beach. And then Oasis accepted in exchange a 5-year note having a maturity value of $35,247 and no stated interest rate. The land originally cost Oasis $14,000. At the date of sale, the land had a fair market value of $20,000. Oasis uses the fair market value of the land, $20,000, as the present value of the note. So here's our notes receivable, $35,247. And we got that as the future value using an Excel functions to calculate that. And so now the discount on notes receivable are going to be $15,247. The land is going to be valued here at $14,000, and the gain on disposal of land, the difference between $14,000 and $20,000, is going to be $6,000. So Oasis is going to amortize the discount to interest revenue over the 5-year life of the note using the effective interest rate of 12%. Okay. Right. All right. Valuation of notes receivable. Here, short term is reported at the net realizable value, the same as accounting for accounts receivable. Long term, the FASB requires companies disclose not only their costs, but also their fair value in the notes to the financial statements. So let's look at that a little bit. Here, on December 31st, 2025, Vincent Company rendered building restoration services to Sylvie Corporation at an agreed price of $102,949, accepting $40,000 down and agreeing to accept the balance in 4 equal installments of $20,000 each year at December 31st. An assumed interest rate of 11% is imputed. Okay, now we're going to prepare the entries that would be recorded by Vincent for Alpha, the sale in exchange for cash and the notes receivable, prepare an amortization table, and Bravo, the cash receipts and interest on the following dates. And they're going to assume that the effective interest method is going to be used for amortization purposes. Okay, both on December 31st, 2026 and December 31st, 2029. So now we're going to record the present value of $20,000 annuity at 11% for 4 years. Here's the factor. We take the 20,000 times that factor, we get 62,049. And then the down payment's already at present value, so we add the two of them together, we get 102,049. Okay, so here's our cash, 40,000. Here's the note receivable for 80,000. And then the discount is going to be 17,951, which will be the difference between 102,049 and 120,000 here. Okay, so now we'll take this 62,049 in our effective interest amortization schedule and ripple it through like we've been doing. We're going to use our effective interest rate, our 11% here, to calculate our 6825, and we decrease the carrying amount all the way to 0 in this case. And we'll receive our 20,000 in cash, the interest, and that will decrease the carrying value by these amounts every year until we finally amortized away all that 62,049. Okay, so our entries here, based on the amortization schedule, we're going to receive our cash. That's an easy one. But then we'll do our discount on the notes receivable and interest revenue, just like we did before. And then finally, in December 31st, 2029, we'll do the same cash entry here and the revised discount on notes receivable from the amortization schedule. Okay, let's explain now the additional accounting issues related to accounts and notes receivable. Here, an owner may transfer accounts or notes receivable to another company for cash. Why would they want to do that? Well, sometimes they need the money. That's almost always why they need to do it, which is number 2 here. But competition and billing and collection are time consuming and costly. We may just outsource that to a third party to do that for us more efficiently. And that transfer is accomplished by securing the borrowing, or outright sale of the receivables. So the factors are companies or banks that buy receivables for a fee, and I might add a large fee, because, and then collect the payments directly from customers. A sale of receivables can be arranged in one of two ways. A sale without recourse. So the purchaser assumes the risk of collection. That's why it's such an expensive fee here. The transfer is the outright sale of those receivables. The seller records a loss on that sale. But with recourse, the seller just guarantees the payment to the factor. Okay, let's look at an example here. The company EBC will sell $500,000 of accounts receivable to Blue Line on a without recourse basis. As part of the agreement, you will transfer the receivable records, sometimes referred to as the invoices, to Blue Line, which will receive the collections. Blue Line assesses a finance charge of 3% of the face amount of the accounts receivable and retains an amount equal to 5% of the accounts receivable for probably adjustments for sales discounts, sales returns and allowances, etc. What entry should EBC and Blue Line make to record this transaction? Well, from EBC's standpoint, they're going to get the cash, right? $460,000. But the receivable from the factor is going to be the 5% of 500,000, here 25,000, and then the loss on the sale of receivables is going to be the 3% or $15,000. And the accounts receivable will be taken off the register here. So you can take a look at how you would calculate that 15,000 a little bit differently here. Here's the 500,000, that's the carrying or book value of the receivables, the cash proceeds. So this 25,000 is the receivables that you're gonna from the factor, and so the loss is going to be the 15,000. But if you're Blue Line, you're gonna now record those accounts receivable at 500,000. You're due from the customer this $25,000 here, you know, and your interest revenue is going to be this loss of the sale of revenues here at 15,000. So the cash that you give up for all that is going to be 460,000. Okay, but if you had recourse in this situation, what would you do? Same numbers, I think, here, except that we've determined that recourse liability has a fair value of $6,000. What are you going to record now? Well, here you're going to record the cash you received, the $25,000. That'll take you down to 485,000. But now you have a recourse liability of 6,000. So your net proceeds are 479,000. And then the carrying book value was 500,000 here. Net proceeds was 479,000. Your loss on the sale of those receivables is 21,000. So your journal entry will be the 460,000 cash, the receivable from the factor, the loss on the sale of receivables, the note receivable going away, and the recourse liability of 6,000. And then Blue Line will have 500,000. They don't have any real difference between that and with or without recourse. So Blue Line's net income is the interest revenue of 15,000. Okay, that looks like a good place for us to stop this video. And when we return, we'll be looking at a loan the EBC makes. Until that time, bye for now.